inspiration that led success so high. I will achieve, I will fly high. I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Last week, the Reserve Bank of India allowed international trade in rupee. The move came when India increased its oil imports from Russia and sought to counter the Chinese dominance of the yen. The move is also expected to shore up the currency as RBI battles to keep the rupee range bound and not slip further against the dollar. Good morning, my name is Ishan Gera and you're watching the Business Standard Banking Show. In today's episode, we'll cover our poll on the rupee and the ARC JC Flowers bagging the bidding rights for 48,000 crore rupee stressed asset portfolio from the Yes Bank. We have an interview lined up with Bhaskar Babu, MD and CEO of Surya Small Finance Bank. Our Banking for You section explains what payment aggregators are, and our banking expert Tamal Bandyopadhyay sheds light on the problems with the government privatization plan. But first, here's a look at the significant developments of the week. On Tuesday, rupee breached the 80 to a dollar mark before recovering to below 80 levels. While the RBI is trying to keep the currency from slipping further, a Business Standard poll found that the rupee will settle at 80.2 per dollar by July end and stabilize at 80.5 level in the September. Experts believe the worst may be over. The rupee has lost 7% against the greenback since the start of the year. Pressure is easing off Yes Bank as well as it takes the road to recovery. The private sector lender accepted JC Flowers Asset Reconstruction Company as a base bidder for its 48,000 crore rupee stress loan portfolio. JC Flowers has made a bid of 11,100 crore rupees to buy stressed assets of Yes Bank. In March 2020, RBI announced a reconstruction scheme for the bank. Reports suggest that Yes Bank may also invest 350 crore rupees in JC Flowers for a 20% stake. It is also planning to raise $1 billion in FY23 to bolster its core capital. On the other hand, the government is pushing banks to join the account aggregator system. Finance Minister Nirmala Sitharaman directed all public sector banks to get on the account aggregator system by July end. The centre's digital initiative to improve credit delivery and make customer information accessible with consent will help provide better services. 9 private banks including HDFC, ICICI and Axis are already on the system. PNB, Union Bank of India, Canara Bank and Indian Bank are the PSU lenders who recently connected to the account aggregator system. There is some relief in store for the insurance industry as well. Last week, the Apex Court said that an insurance company could not be held guilty of deficiency of service solely for delay in processing claims. In an appeal filed by the New India Assurance Company Limited against the National Dispute Redressal Commission order, the court said that a delay could be one of the factors but not the sole determinant. The road has not been as easy for small finance banks. 5 years since they have been in operation, they are still trying to find their way in the banking sector in the country. In discussion with Business Standard's Manojit Saha, Bhaskar Babu, MD and CEO of Surya Small Finance Bank, talks about the growth and recovery after COVID-19.
Welcome to the Business Standard Banking Show. The universe of small finance banks form 1% of the total assets of the scheduled commercial banks in India. The Reserve Bank of India, in its recent financial stability report, observed that the high balance sheet growth of small finance banks from a very low base has raised some concern on the asset quality front. Also, RBI has said the SFB's restructured standard advances portfolio remains higher than the pre-pandemic level, though it is below the peak level of September 2021. To discuss the issues surrounding the SFBs and particularly of Surya Small Finance Bank, we have today Bhaskar Babu, MD and CEO, Surya Small Finance Bank. Welcome to the show, Mr. Babu.
Thank you much.
Sir, first let us focus on the SFB universe, some of the issues which are facing the SFBs, then I will come to the bank in particular a bit later. Do you think SFBs are going at a bit of fast pace and sometimes compromising on the underwriting standards?
I do not really think so, but however, you're all new to banking, just 5 years old across the universe, quite a bit of a learnings on the go. So all the growth that we do at this point of time has to also be balanced by adequate or more than adequate risk control measures. So to that extent, the regulator wanting us to rebalance the portfolio, moderating the growth meaningfully to make sure that we don't really cross the line in terms of where the growth creates more risk than is known to the bank itself. So to that extent, yes, but otherwise, I do not think that SMBs are growing at a pace compromising the underwriting standards. However, in the last 5 years, last 2.5 years, we've seen an unusual impact of a once in a lifetime of event probably is in terms of the COVID and impact. And the impact has been substantially larger on the low income households than probably on the other segments. So to that extent, the negative impact that we all felt, it was a little more. And the good news is that as the economy is recovering, this segment of ours is probably recovering a little more faster. And we are seeing an improvement across all parameters, including collection efficiency, including in terms of reduction in GNPA. And also many customers were not paid for many months together, usually was presumed will turn only into a write-off. They're coming back as they're wanting to get back into the borrowing fold and want to kind of have good track record, which enables them to be financially meaningful.
RBI has also observed that the standard restructured portfolio of SFBs have remained higher than the pre-pandemic levels. Do you see a significant part of the portfolio turning non-performing going ahead?
It does on a temporary basis, yes, not significant, but close to 60 to 65% of the portfolio starts paying. When they start repaying after coming out of a moratorium, there is this possibility of them skipping an installment once in 2 months, once in 3 months, which from a time stamping point of view may convert itself into a non-performing asset. But will they really tend towards a write-off credit loss? The answer is no. So the customers, as they come out of a moratorium of 6 months and 1 year, the repayment while they start repaying the installments, that kind of the inability to repay every month on time after a gap ahead tends to kind of make probably 30 to 40% of the customers into the non-repayment, some depending on institution to institution, but they may not necessarily turn into a credit loss, as these customers have had good track record and probably have gained quite a bit in terms of ability to pay. The timing will be of some essence.
But overall, do you think this year could be a normal year? Last 2 years, I know SFBs and MFIs have a lot of pressure because of COVID, but do you expect this year to become a normal one like the pre-COVID one overall?
I would summarize that it tend to be a very normal year. In Q1, sequentially every quarter should look better than the previous quarter, barring any other unknown impact really happening. But as things stand today, so every quarter sequentially looks to be kind of better, will kind of pan out to be better than the previous quarters. Okay. It will move towards normalcy as the year progresses.
Coming to Surya, the small finance bank, the bank has recently released the Q1 business figures. Are you slowing down your business growth consciously and focusing more on collections and recoveries?
Usually Q1 is never substantially higher than Q4 across the financial services or banking segment. So to that extent, we're not slowing down on growth, but however, we are very, very focused in terms of ensuring that the growth is not coming at the cost of robustness of the portfolio or collection efficiency. So there's equal amount of focus going on. There has been a 25 to 27% growth across all parameters on a year-on-year basis, which is what we have been targeting. Our intent itself, as guided earlier, is to have a good growth range between 20 to 21% across all parameters year-on-year.
What kind of loan growth projection you have for the current financial year?
So as we guided earlier, targeted loan growth on a very stable basis will be between 20 to 25% across all parameters, both deposits as well as in terms of assets. So 20
to 25%.
That's right.
So you have kind of toned down your loan growth from what you have projected earlier?
No, by and large we guided around same 25. So 20 to 25, we'll continue to maintain that. And this year will be a year where we'll clearly kind of invest substantially in terms of technology, in terms of risk management systems, and ensuring that your backed asset portfolio is substantially much better than we ended the last year with. So there will be equal focus in terms of collections, portfolio quality, substantially higher focus there. And given that the robustness has come back into the microfinance customer households and also the other segments that we operate, the focus will also be in terms of balancing the portfolio. So to that extent, we will stay with earlier guidance between 20 to 20%.
Coming to the collection part, the collection efficiency, Suryodaya has beefed up the collection team. There are, I think, quite a number of people specifically focusing on collection. Have you seen an encouraging trend in the first quarter so far as collection efficiency is concerned, and what kind of collection efficiency you're looking at for the entire year?
So we're looking at a collection efficiency growth of 2% every quarter. So we are at closer to 90% at this point of time. So our intent is to really kind of go beyond 95% towards the end of the third quarter. And
95%.
and the collection efficiency of the portfolio built after July 21, which is post COVID 2, is currently running at around close to 98.5 to 99%. We intend that will continue to be so, and as the portfolio gets substantially built out of the new portfolio, collection efficiency go up, and the old collection efficiency was at around 70 to 75%. And we have seen a good traction in terms of, because of the collection, specialized collection task force, which is focused in terms of customer who are not paid even for 6 months at a stretch. As we get in touch with the customer, we have seen quite a bit of around closer to 30 to 35,000 customers coming back into the paying fold who have not paid for longer. So it has worked for two reasons. One, I think as a number of delinquent customers went up, the ability of the regular team to be in touch with them on a continuous basis, on more frequent basis, got diminished. So with the focus of the collection team, more than the collection team, it is a team which is focusing in terms of getting back in touch with the customer. We see lots of customers coming back in terms of the repayment. So that is what gives us the confidence to edge the collection efficiency by sequentially by 2% every quarter and close to 95% by end of Q3.
Surya, this gross NPA was 11.8% as on March, and you had a target to bring it down by 8% to 8% by the first quarter. Given the trend in the first quarter, do you think you are on track to achieve the target?
We are yet to declare our results, so to the extent some of these numbers will not be able to kind of disclose. But however, what we guided 8% was towards the Q2, not in terms of where we were right. It was not the targeted one is to go to Q2 during the year and not at the end of the Q1. In Q1, what we guided was that we will provide for closer to 40 to 50 crores of provisioning as is required. So which will be the residual provisioning for what we see as stressed assets, and a spillover of that will be in Q2. So we are kind of on target in terms of what you indicated as a number of less than 8% towards during the year, and well could happen during the middle of the year.
What is the longer term, medium term roadmap for gross NPAs? What is the level you are seeing, say 4 quarters or 5 quarters down the line?
I think the ideal one which we'll target, which we should kind of get into it, is around sub 3% to 4% in terms of GNPA and sub 1.5% in terms of NPA, considering the segments that we are operating in.
By when you want to achieve that?
Probably closer to the end of the year.
Last year, the provisions made by banks was about 400 crores. So this year, do you think provision could remain elevated, or provisions requirement could be much lesser?
So as we guided, I'll go by what guidance we have given. We guided that whatever provisioning that we required will be done in Q1 and spillover in Q2 for the whole portfolio, and thereafter whatever provisioning would be required would be more towards in terms of a regular normal portfolio as a really build up. So it will not be as elevated as was last year, as we also guided that the worst is probably over from in terms of whatever provisioning that we do. So it will not be as elevated or as higher as last year.
On the cost income ratio front, you were able to cut down the cost income ratio significantly to around 60% from 67% at the end of FY21. Where do you see the ratio going ahead by the end of the year?
We're always a bank with a cost to income of less than 50%. The target is to move towards that. It may not necessarily happen during this year, but clearly the trajectory will be in terms of taking it closer to sub 50%, probably a few quarters away from now.
I mean, how do you see the rising interest scenario in terms of customers' ability to repay? Do you think the kind of interest rate increase that people in the market is talking could impact to some extent the ability to repay?
Usually, these have a direct impact on larger ticket loans taken for longer tenors, where even a small movement in interest rate increases the EMI by a couple of percentage points. Since we are in the low ticket, low tenor segment, one, we are not intending to pass on 0.5% or 70 basis points increase to our microfinance segment at all. We are retaining the same pricing at which we operated even 6 months back at this point of time. While we are also having an excess liquidity. So most of this liquidity, which is low earning at this point of time in treasury instruments, will get converted into earning assets. So to that extent, the impact of an incremental increase of 50 to 75 basis points in the cost of borrowing or cost of deposits will not have any impact on the P&L for this year.
Mr. Babu, thank you so much for speaking to Business Standard. It was a pleasure talking to you, sir.
Always, thank you very much. Good day.
Thank you, sir.
Bhaskar Babu says that as the economy is recovering, many customers are returning to the banking fold and GNPAs are declining. Another change is that RBI is pushing for more technology and oversight with a payment aggregator model. Our experts explain what payment aggregators are.
Payment aggregators or PAs are essentially entities that facilitate e-commerce sites and merchants to accept various payment instruments from the customers to complete their payment obligations without the need for merchants to create a separate payment integration system of their own. They facilitate merchants to connect with acquirers. In the process, they receive payments from customers, pool and transfer them to the merchants after a time period. There are two types of PAs, bank and non-bank PAs. While bank and non-bank PAs handle funds as part of their activities, banks provide such services as a part of their regular banking relationship and do not require a separate authorization from the RBI. However, RBI asked non-bank PAs to get authorization by applying for a license. The PA regulations were a grey area before March 2020. Given the critical functions these intermediaries perform in the online payment space and their role in handling funds, the RBI decided to regulate them in their entirety. PAs have to be a company incorporated under the Companies Act. In March 2020, the Reserve Bank issued guidelines for PAs. Existing players had to ensure a net worth of 15 crore rupees by 31st March 2021 and 25 crore rupees by the end of 31st March 2023. Similarly, new PAs had to have a minimum net worth of 15 crore rupees at the time of application for authorization and 25 crore rupees by the end of the third financial year after the grant of authorization. The RBI rejected several firms for a PA license, while many received the nod. According to some reports, about 180 applications were filed with the RBI. Several payment providers such as Razorpay, Pine Labs, Stripe, and OnePay received an in-principle nod, and more players are expected to get it in the future.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The banking sector is also primed for major changes apart from technology. As the government opens up PSPs for privatization, our banking expert Tamal Bandhopadhyay explains its need and the best way forward. Hi Tamal, thanks for coming on the show again.
Thank you.
You're writing this column right at the time that the nationalization week is occurring, right? So the first question that comes out is, has nationalization outlived its lifetime? And is privatization the pill for the solution, complete privatization?
Well, it's a very sensitive subject, you know. If you ask any public sector banker, they will get into the nostalgia trip that how they built bridges and roads and how they went for financial inclusion and brought banking to the masses. So yes, indeed, nationalization has served its purpose, but probably there's a time to go beyond it. That's the government policy also. If you have seen, Prime Minister Modi has said that the government has no business to be in business. And so, yes, to some extent, I would say, I would not use the word outlive, but I would say the other way, appreciating the sensitivity of people. It has served its purpose. And probably now it's time to look beyond it. And as far as privatization is concerned, as 2021 February budget spoke about starting with two banks. So I would like to believe it's an experiment. Having said that, privatization, is it the panacea? Definitely, if you look at the other side of it, is every private bank doing well? Certainly not. I mean, there is governance issues, there is business model issues. Let's not name any bank, but they are not the, not all of them are the best example of how banking is done. Even if government wants to bite the bullet and go for larger privatization, I think for the masses, for social banking, it must have a few banks under its belt. It needs to be, because when you have, say, Jan Dhan Yojana, or when you have, want to reach out to the masses, it's basically, I will not say that using it as a political weapon, but it's a socio-economic, it's a vehicle for, to address the socio-economic issues. Then you don't treat them as a business entities. Don't expect them to be hugely profitable. Don't look at ROA and ROE. Focus on the purpose. It's for socio-economic purpose, and let them be that.
But that socio-economic purpose that you talk about can also be solved by RBI guidelines and instructions. Priority sector lending is one. The RBI can also instruct banks to do Jan Dhan accounts as well. So why have those banks if you can get RBI to, if RBI can get private sector banks to do the same things?
You look at Jan Dhan Yojana, the numbers, and if you look at the percentage of the participations of private banks and then public sector banks, then you will see why it is. I mean, there are norms, yes, 40% priority sector is norm for everybody. That there is no escape for that. But apart from that, there are, that's always there. And the priority sector norm is, it keeps on changing. It's not a static thing. But the others like PMJDY, etc., whenever the government comes, you look at the participation of private sector. It's not comparable with public sector. So they are reluctant because they care for the balance sheet, they care for the quality of assets, they care for ROA and ROE. They are answerable to the investors, which is not the case with the public sector bankers. Public sector banks know that the government is there. It's a PC Sarkar's magic. They used to say that one pitcher, he will always turn it upside down, and it's the water of the Ganges, and it's given by my grandma, and it never dries up. Every 15 minutes in between the play, every play, every magic trick, he will put this pitcher upside down and shows that it's the water of Ganges and the pitcher is given by my grandma, and it never dries up. So for the public sector banks, recapitalization is the water of the Ganges and the grandma is the government. Not to make money. Money you can make through divestment. But privatization, actually government does not want to keep on pumping in this recapitalization fund.
Now, when you talk about previously privatization in your column, you talk about bringing the stake down to below 51% may not be enough. So would it be better if the government brings down the stake to 26% and still keeps strategic control, or does it need to go even below?
At least 26%. At least 26%, because under the Companies Act, 26% gives you the power to block any resolution. So at least 26%. And more importantly, which I have pointed out also, it's not the ownership, but how the owner behaves. Right now, the Bank Nationalization Act gives government powers, like for everything, right from telling bank what is to be done, to appointment of the CEOs and other directors, to everything else. Unless the government cedes its control, who will be interested in putting in money in this, in these banks? As you are aware that if you and me put in money right now, I mean, it's our voting right is capped at 10%, but that's not applicable to government. So then either you make it proportionate to your holding pattern, or you make it 26%, or how much you hold, whatever is less. So right from the cap on voting has to lifting the cap on voting to the various rights, controlling rights, which the owner enjoys at this point of time under various sections of Banking National Act, they need to be changed.
Now I'm taking you off topic. In a recent paper in July Monthly Bulletin, Michael Patra said that the worst for inflation may be behind us. A recent BS poll shows that rupee may not slide beyond 80.5 to a dollar in September. Does that mean that RBI may not be as aggressive on hikes as we had perceived, and we may well remain below the 6% mark?
So 6% is farther away. You're talking about the interest rate 6%, right?
The repo rate.
It's far away right now, 4.9%.
Yeah.
Now if you see in the recent past, various global banks have hiked rates and very aggressively. As we speak, US Federal Reserve will probably go for 75 basis points. Earlier it was talking about 100 basis points. Now at this point of time, if you do not respond to other central banks' rate hike, then definitely you are creating a situation where nobody will be interested to take exposure in India as far as currency is concerned because of the interest rate differential. So RBI cannot afford not to hike the rates. Now, what will be the pace and how it will be done? That's the question. The governor has said that he'll look for soft landing. So does the soft landing mean that you go for 10 basis point in every policy? Certainly not. I'll be surprised if Reserve Bank of India does not go for 50 basis point hike in the next policy, August policy. That will take it to 5.4, and then rest is depending on the inflation trajectory and the rupee movement, whether you'll go for 25 bips each and all. So it's 5.9 and 6 point plus 6.25 kind of thing by the end of the fiscal year. I don't think you have any choice but to, because you need to both contain inflation as well as currency depreciation, and interest rate is one weapon to fight both.
Perfect. Thank you. Thanks a lot for your time. We hope to see you back again soon. Thanks a lot.
Thank you.
Kamal believes the government should keep some banks to promote social change. It should not focus on returns then. He points out that privatization is necessary to stop the recapitalization tap. We'll be back next Thursday with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.